Good afternoon, good morning, good evening, wherever you are. Welcome to the July 27th Valutrades webinar. Today, we're going to be looking at when to exit a trade and take profit. My name is Brad Alexander, and hope you've enjoyed our webinars and videos every week. I'm here to guide you through some interesting topics today. And if you have any questions, please type in the question. If you've got your webinar software there, send me a note, ask questions as we go along. It's always great to have some interaction from our guests. Right, again, my name is Brad Alexander. You may know me from the Monday morning and Tuesday morning videos. I've been working with Valutrades for a number of years now, doing quite a few things, and I certainly enjoy doing our webinars every couple of months. I'm a trader. I've been trading for many, many years as a retail trader and a professional. I used to trade the peseta. If you don't know what that is, Google it. We used to trade the hard way through the banks. So I got involved, obviously, in online trading when it came around, and it's all been good fun, and I hope you guys are enjoying it too. So we're here to help. So let's get going. What I do day to day, as you know, as I said, I provide content for Valutrades and a number of other companies. You've probably seen my videos every Monday and Tuesday mornings. And we're going to be talking about that a little bit today. And what's ironic, I thought to myself today, is that I and myriad other people talk about how to get into trades, and we very rarely talk about how to get out of them. So I hope that this webinar will be very valuable to traders, both beginner and intermediate. Right, but before we get going, of course, CFDs and FX are leverage products, and your capital may be at risk. If you don't understand leverage, you don't understand the risks involved, please go to the Valutrades website and take a look at the risk disclaimers. It's important that you understand this before you invest any real money in your trading account. And as usual, any strategies that you learn today, please practice them on a demo account before you get going. And if you have any questions about leverage or about risk management or about anything to do with anything to do with anything, is jump on the Valutrades chat line, which is on the website. Amazing team are there to help. Right, so as we said, today we're going to be talking about getting out of trades. And before we do that, I'm going to zip through a few of the basics about getting into trades. I mean, there's no point in talking about getting out of trades if you're not in profitable trades. We're not here to tell you how to get out of money-losing trades. You can do that yourself. Hopefully you don't have too many of those. I'm fortunate, I've been doing this for a number of years, that my risk-reward ratio and my win rate are reasonably high, so I'm happy about that. One of the things that we try to do is to educate our Valutrades clients and others who are following the videos and blogs to manage their risk and hopefully create more profitable trades. So to do that, we very often look at technical analysis. I'm not going to spend too much time on getting into trades because you probably already know about that. But it's important as well to have a trading plan. Whether you're getting into a trade or getting out of trade, always have a plan. Write it down on a spreadsheet and stick to it. For your success as a trader, again, getting in, getting out, you need to have a proper plan. And in part of that plan, I'm going to show you my order of analysis, I like to call. It's basically a checklist that I have for getting into trades. Once you learn about how to get into trades, it actually makes it much easier to understand how the market's moving, how the market's working, how the charts are working to get out of trades. So before we can talk too much about exiting trades, we need to understand that we're comfortable with getting into trades. There's no point in getting into a lot of money-losing trades because you will be stopped out all the time. You'll be too many negative numbers on your chart, and nobody wants to see that. Right, getting out of a trade is a lot to do with trading psychology. Trading psychology, when you think about it, has very little to do with getting into trades. Trading psychology kicks in when you're in a profitable trade, or heaven forbid, a money-losing trade. You very rarely hear people talking about trading psychology when they're doing their analysis. It only happens really when you click the button and when you're into that trade. And we're going to be talking about that quite a lot today because it is a key part of getting out of trades. I find a lot of students when they're first learning, they typically sometimes will panic. They're in a profitable trade. Hey, this is great, and they get out of it. They get out of it too soon. So what they've done, they've they've panicked, they've not followed their plan, and you've heard the phrase many times, fear versus greed. They've come into succumb to fear versus sticking to their plan and carrying on. So we're going to be talking about that a little bit as well. And we're going to be looking at a full list of exit strategies. It was amazing when I went to put together this program for you, how many there actually are. So I don't want to confuse anybody, but what I want to do is to give you, the trader, the tools to go away and practice some of these exit strategies and come up with what works for you as a plan. And pardon my dog barking in the background. Working from home is a joy, isn't it? Right. So getting into trades, we are using very often technical analysis, and to understand technical analysis will help you as well in exiting trades, and I'm going to show you why. So typically we look at technical analysis, we look at historical indicators for one, which is are things like moving average crosses. On this little chart you can see stochastic oscillator and MACD. There are, as you know, as a trader, there are a myriad different ways to set up your charts with indicators. And you can use these indicators not just to get into trades and to manage your risk, but also to get out of trades. And I'll show you how to do that. So there are a lot of historical indicators like the Bollinger Bands and so forth. And the ones that you like to use. In fact, I know some traders who actually will enter trades based on certain indicators and exit trades based on others. And I'm actually part of that camp. So I'll explain what that means as we go along. Right. Technical analysis always includes chart patterns, formations, even support and resistance. And if you watch my videos every Monday and Tuesday morning, you know I'm always drawing lines on charts. I drive my students crazy. I'm saying, I don't care. Every time you open up a chart, draw lines. Support, resistance, trend lines, patterns, double tops, double bottoms. I want to see you drawing lines all the time. I never stop drawing lines. When I do my videos, it's not just for your benefit, it's because that's the job. When I'm teaching someone to trade, it's that simple. Drawing lines is the job, and you need to be doing that all the time. So using your chart patterns to get into trades can also help you look at how to get out of a trade as well, hopefully a profitable one. Candlestick formations and patterns are also important with technical analysis. I have to admit, I don't use them all the time, but when you see them, it's a nice confirmation to have. And of course, we have Fibonacci. Fibonacci isn't an indicator, it's actually a graphic. But the beauty of Fibonacci is that a lot of professional traders use it. And it's very, very common. It's almost like a fait accompli. It works because it works. Basically, if you draw Fibonacci retracement on a chart and you don't see anything, then erase it. If you do see something, it's probably there for a reason. And it follows along as well with support and resistance. We're going to be looking at that as well. Again, I don't want to dwell on this too much. These are slides from a previous lesson about getting into trades. You need to follow your plan. And if your exit strategy is on that plan, then good for you, but stick to it. And it doesn't mean you have to use the same exit strategy for every single trade you get involved in. That is just not the way it works. Every instrument is different, whether it's Forex, indices, oil. You could have a different time frames. You could have a different exit strategy for different strategies and different assets. So there's nothing that says you have to learn from this webinar today, carve it in stone, and that's it. You need to be flexible. But as long as you have a plan and stick to it, and be disciplined. Again, we talked about succumbing to psychology. That's trading psychology. That's one of the best ways to fail, is to either be too greedy or to panic and close a trade too soon. So, and develop a checklist. I'll show you quickly my checklist for getting into a trade. It's important to have a checklist to get out of a trade as well. And we'll be looking at all the different ways and the different exit strategies that you can use to create that checklist. And again, don't forget about your risk management. There's no point in just willy-nilly clicking buttons. And even if you have a good entry strategy, you need to be able to set your position size correctly. You need to have your stop loss set. And we're going to be looking at stop losses in a bit of detail during this webinar. And again, if you're learning a new strategy, even an exit strategy, practice on a demo account. Right. Order of analysis. I like to, in fact, I printed this out. I sent this to a student a few weeks ago, and he actually stuck it on his wall as a mantra. And this is my order of analysis for getting into trades. And it's also very important to understand these things to get out of trades. I've put this little graphic on this slide today, and if you've been following my videos, either Monday or Tuesday or both, I hope, I talked about going short on Kiwi dollar. And I'm going to go through the order of analysis as to why I got into that trade and why hopefully a lot of people got into that trade. So when I look at a potential trade on anything, whether it's Forex or indices or commodities, I look at the fundamental side of things first. This particular graphic is Kiwi dollar, as I said, and I've gone short. And you can see, if you can see the lines, you can probably see that I'm actually in more than one position. Fundamentally, it made perfect sense if you saw Monday's video. It even made more sense today because of all the turmoil going on in China with the equities market. And as I said this morning, is that the New Zealand dollar and the Australian dollar are very sensitive to things that happen to the Chinese economy. So if things are going bad in China, it never reflects well on New Zealand and Australia because a lot of their commerce and trade are based in China. So straight away, we have a potential fundamental reason for going short on Kiwi dollar. Right. Again, support and resistance. I went short on this because we were well above support. I never go short on a trade if you're too close to support. And we were also well below resistance. So that was covered. Support and resistance were covered. If there's one indicator or one thing that you do on charts, support and resistance is it. I'm going to be looking at that in more detail. Chart patterns. Well, you can see here I've drawn some trend lines. And so I've got my fundamentals covered. I have my support and resistance covered. And what I got when I got into the trade, there was a bounce off the upper trend line. And if you see my videos, I'm always talking about a bounce off the upper or lower trend line. That is, to me, is absolutely critical. There's no way I'm going to be going into a trade unless I can see that there's a reversal or I know the direction it's going in. In this case, it's a downtrend. The trend is your friend. I'm going short. I'm not going to try to go against the trend. So we have all those boxes ticked as we go along. And an indicator. And again, I use the stochastic oscillator to confirm the trade. So we had our four basic boxes that we can tick on this trade. And hopefully you can see that it's actually working out very well. So, but it's been driving me crazy all day. I was in the trade yesterday. I actually got into a second trade. I scaled into a trade today. And as you can see by the videos, I typically look at the 4-hour chart to do my analysis, maybe the 1-hour chart. Typically the videos are 4 hours because I don't want to give you guys 1-hour charts that could have, and the potential for the opportunity to expire too soon. So what we're looking at is a 4-hour chart, and I like to enter on, say, the 15-minute or 5-minute chart just to get a feel for what's going on and to time my entry better and to bag some extra pips. So if you can see on this chart, I've actually set my take profit at the very bottom, and that's one reason I like to do that. Is that trend line, the lower trend line, is intersecting, of course, with a swing low. We've got 1, 2, 3 swing lows, so we've got a proper trend line, and I'm hoping price will get down there. The problem that you have in doing that, and it's a good thing if you can do it, is you've got a lot of ground to make up in between your upper trend line and the lower trend line. And a lot can happen in between those two lines. You could panic, there could be a fundamental event, it could take days to get there, and it's up to you and your trading psychology and your calmness or your demeanor to live through that. I mean, I'll show you an example during the webinar where I actually got out of a trade too soon, and as soon as I got out of it, price tanked and hit the lower trend line. I could have made a lot more money. That's trading. You all know sometimes you get out too soon, sometimes you stay in too long. Using technical analysis skills can help you get over that, and being calm and practicing and getting some experience with these trades can help overcome trading psychology issues. So anyway, so we're in this trade. Oh, I did mention as well, I got into the second trade on Kiwi dollar because I was on the 5-minute chart looking around, and I found a very beautiful looking symmetrical wedge forming, and I thought, okay, that's definitely a bearish pattern. So I waited for the right moment, got involved again with a smaller position size, and hoped that it would carry on down. Well, it didn't, but I didn't panic because it carried on up. I didn't panic because I knew it was going to happen. I was hoping it was going to happen. Price came and hit the upper trend line on the 4-hour chart and reversed again. So now both trades are in profit. So I didn't panic. I trusted my instincts. I trusted my trade. And now I'm figuring out a way to get out of it. If you can see on this trade now, price is at resistance, sorry, support. So it takes a bit of getting over your trading psychology, fear versus greed, to let price get through that level of support on a downward trade, on a short trade. That can be very nerve-wracking. So it's up to you whether you close the trade at support or whether you let it carry on to the lower trend line. Oh, and I look at candle patterns sometimes as a confirmation. So, okay, we spent a bit of time talking about how to get into a trade and a bit of psychology about what to do when you're in the trade. Let's carry on and talk about a bit of trading psychology and exit strategy. Any exit strategy, I don't care what you call it, it does involve trading psychology. I hate to sound boring, but that's what it's all about. I remember years and years ago, I went to a seminar put on by CDAN, the newspaper, and there were literally 1,200 traders in the room at the conference, and he talked to every one of them, and they all had a different strategy for getting into a trade and getting out of a trade, but they all had one thing in common. They knew what their risk was, and they knew how to manage their risks. It was that simple. But they all, if you talk to a million different people, you'll find a million different psychological types. You need to find a system that works for you. And one of the things that's important for a new trader or any trader is to find a time frame that works for you. I'm lucky in the fact that if I have time, I can scalp on the 1-minute chart, but very often I'm trading, as I just said earlier, on the 4-hour chart. It's very difficult. It was very difficult for a couple of years to segregate those two mentalities, but it's all about learning about trading psychology. If you can't handle scalping at the 1-minute chart, then just simply don't do it. Stick to higher time frames, deal with things that your mind can deal with, that you don't lose patience, and things that just don't frighten you, and then be confident with your trade. So find a time frame that works for you is a really important thing to getting a handle on trading psychology, and also with exit strategies as well, because if you're as you know, if you're trading short time frames, you can get a lot of price action that you don't want. It is a lot of whipsawing, whereas longer time frames, you can control it. It's a matter of patience. Right, pick an exit strategy within your stress level, and as I mentioned, and I remember a professional trader writing something a few years ago saying that we spend, minutes, days, weeks analyzing our charts, doing this, plotting that, reading the news, getting into a trade. And as soon as we click the button, our brains turn to mush. And that is not uncommon. If you feel that way, sometimes you're not alone. So what you need to do is, as I say, pick time frames that you can deal with, pick an exit strategy for hopefully from this webinar that you can deal with, and stick to it. If you're finding that you can't handle swing trading, that trades that last days and days, you're more happy, you're more comfortable with intraday trading, then do it. It's that simple, and it's the same with the exit strategy. And again, as I said many times already, anything you learn tonight or anything you learn anywhere, practice in a demo account. There's nothing like getting excited, thinking, oh, this is it, this is the holy grail of trading, and you dive right into your live account, fire up your position size too high, and then oops, then you can't sleep that night. Right. A lot of what we're going to be talking about today with exit strategies will have to deal with risk-reward ratio and win rate. If you don't know what risk-reward ratio is, it's critically important to understand what happens when you lose a trade versus what happens when you close a profitable trade. And I mentioned earlier about some, say, students who are panicking and closing their trades too soon. I mean, and they're saying, okay, I booked a profit. Well, that's great, but what about the ones that go the wrong way? And you've got your stop loss set at 1%. And if that trade keeps going, all these trades keep going the wrong way, and you're losing 1% every losing trade, and your profitable trades are only 0.5%, your risk reward ratio is not right. Something's wrong. You're either panicking or you're not getting into trades in the first place. And this is critically important with your exit strategy. If you have a high win rate, you can actually get away with a lot more with your exit strategies, and you can have a lot more fun. I hate to tell you right now, my win rate is, I've got, I think my last 12 trades are all profitable, and I've got 2 on the go right now that are in profit. So my win rate is very high. That gives me the leeway to either let trades run or, and again, not ramp up my position size. That's not the temptation I'm talking about. I stick to my plan. But if your risk reward ratio is good and your win rate is high, you can experiment a bit and maybe let trades run a bit more and then play with your exit strategies. And again, there's fear versus greed. We go on and on about that. There's nothing like being greedy and letting a trade, oh, let your trade run, let your trade run. And it runs down to your take profit 2 pips away and comes back and hits your stop loss. Yes, it's aggravating, but it happens. But if you follow some of the exit strategies that we're going to be talking about, that may never happen to you again. There's nothing like being a professional trader with your investor watching and seeing that happen. It's really unpleasant, and they don't like it, you don't like it. That's one thing as well about trading psychology. You may be learning a lot about trading psychology now. When you become a professional trader, it's a whole different ballgame because you have the investor. Sometimes that's better for you because the investor may have criteria that they need to follow. Some people trade other people's money better. You're more disciplined, nothing wrong with that. But you need to get your game very, very sharp and get your exit strategies lined up before you trade professionally, because you have to justify what you're doing to your investor. And again, as I said, there's nothing like your investor literally looking over at your screen, seeing a profitable trade, and then suddenly it just reverses for whatever reason. And they want to know why. Why didn't you close it? Well, there are ways to alleviate that problem. Right, let me have a quick sip, pardon me. Exit strategies. I'm going to be giving you a list of exit strategies, and then we're going to be going through them one by one. So hopefully we haven't spent too much time on the preliminaries. Now we'll get into the meat of the matter. And again, please fire questions at me on your question box there. I'm happy to answer as we go along. Right, support and resistance. I always say if anybody asks me to pick my favorite indicator or my only indicator, the horizontal line. Support and resistance is critical for everything. A lot of inexperienced traders will get involved in a short or long position without actually looking at support and resistance, and then realize that the trade went wrong because they bought too close to resistance or they sold too close to support. And you see the price bounce off and go the other direction, and you realize too late, oh, I've made a mistake. Constantly plot horizontal lines. It's that simple. And one of the ways to get into a trade is using, say, a short trade, a bounce off resistance, a long trade, a bounce off support. You can do the exact opposite on the other side to use support and resistance to get out of the trade. And that is a very, very effective way to do it. If you only use one thing, use support and resistance for your entry and exit. Trend lines. In the same vein, and I showed you my little chart on Kiwi dollar. Sorry guys, let me just check one thing. Yeah, we're good. I was trading off the trend lines, and I do that very often. In fact, if you watch my videos, I'm always talking about trend lines. So trend lines can be great for getting into trades and also great for getting out of trades. If you get a trade that runs, a short trade that runs from the upper trend line to the lower trend line, good for you. And you had the patience to stick through all the choppiness and all the support and resistance that you had to plow through. That's what it's all about. If the trade keeps going and breaks through the trend line and carries on, and you've already closed it, that's trading. Too bad. Get used to it. You can't win them all, but you'd rather book a profit and get into the next trade than worry about the ones that got away. So support and resistance and trend lines are critical for getting into and getting out of trades. Oops, excuse me. Right, using indicators. There's nothing wrong with using indicators to not just get into a trade, but getting out of a trade. And I'm going to be showing you some examples. I mean, for example, if you like Bollinger Bands range trading, you can get into a trade, say with the upper Bollinger Band and get out of the trade with the lower Bollinger Band. I'd use a confirmation tool like RSI or MACD or stochastics to help you with that, but there's nothing wrong with that. Even moving average crosses, you can get into a trade with a cross and then get out of a trade when the moving averages cross over. And as you know, you can set up myriad different combinations of moving averages, simple moving averages, exponential, different periods. The beauty of moving averages is you can backtest, and the beauty of every historical indicator is you can backtest. The markets change as you go, of course, but there's nothing wrong with using an indicator to help you get out of a trade. I mean, I use stochastics very often to get into a trade. I very rarely use them to get out of the trade, but sometimes I do, just as a confirmation tool with an exit strategy, in combination with, say, support and resistance, or with the trend line, or a chart pattern. Fibonacci, why not? Fibonacci is another form of support and resistance. If Fibonacci is appearing on your chart and it makes sense, there are key levels on that Fibonacci retracement, chances are there are a myriad hedge funds and banks who are using Fibonacci at the same time on that particular instrument, and you may find that price will stop when it hits that particular key level. Nothing wrong with that. I know a lot of traders don't like Fibonacci, others swear by it. Okay, managing the trade. This is one of the first things I learned when I started trading online. It can be a double-edged sword. It can actually get you into trouble and close profits, close trades too soon, or it can be a wonderful tool to lock in profits. And I'm going to show you some examples. Again, when you manage the trade, what it means basically is when your trade is in profit, you move your stop loss to a swing low or swing high, hoping price doesn't come back there. Eventually it does and stops you out. You need to have in your trading plan something that says, okay, I'm not going to move my stop loss until I get to 50% of my profit target, or 25%. Don't just willy-nilly move your stop loss to follow your trade. But I'm going to show you about managing a trade, and it can be very, very helpful. It can be very nerve-wracking. If you're a professional, it helps lock in profit for your investor, which keeps them happy. And it can also help with trading psychology. If you know, you can go to bed at night knowing that your oil trade has got profit locked in. You don't need to wake up at 3 o'clock in the morning to check it. I've done that. You know, it can help you with trading psychology. There's the trailing stop. In fact, I did work for a hedge fund once who insisted that we had trailing stops. Again, that is one of the best ways to overcome trading psychology problems, the trailing stop. You need to learn how to set them. You need to learn how to, you know, the size of the trailing stop, because every instrument is different. A trailing stop on Euro Pound, or sorry, let's say Euro Swiss, for example, which is a very low ATR, is going to be completely different than a trailing stop on, let's say, Pound Yen, which is a massive ATR. You need to be able to back test, play with those trailing stops, play with your demo account on different time frames, and just get used to them. You know, they can be a wonderful, wonderful tool at 3 o'clock in the morning, or they can be very frustrating when you say, oh, shoot, I wish I'd set it fatter, I could have made more money. Again, it's a matter of practicing with it and learning how they work. And again, I'll repeat, trailing stops can really help you overcome trading psychology problems when it comes to exiting a trade. Scaling out, and this is a very, very popular method to get out of a trade that a lot of professionals use, and good retail traders. So when you've got a trade that is seriously into profit, it's well past your target, you can take off a percentage of that trade. And I've made a little video to show you how to do that. It's not straightforward in MT4. Of course, nothing is. But I'm going to show you how to do that. You need to be in profit to do that, but it can be very helpful. And again, it helps you get over trading psychology. If you've got problems, if you've got a very profitable trade and you're having the fear versus greed thing, you can bag some profits, book some profits, take half the trade off, take a quarter of the trade off, and then the rest of it is pure profit, and it's good fun. It's always a good problem to have when you've got a profitable trade. Right, and there's financial goals. Again, I've done this. When you're trading professionally, typically your investor, you know, if they're not a trader, they don't care about Bollinger Bands and descending triangles and rising wedges. They just want to make some money. A very simple way to decide when to exit a trade is to say, okay, I've made my X% per week, I've made my X% per day, and I'm going to show you at the very end of the webinar some of the things that investors will require from you to get out of a trade. when I'm trading retail and I got involved in it, I was hoping to get 1% per day. As a professional trader trading with a large hedge fund, they wanted 1% per month. If we got 1% per month, we were golden. It was that simple. But of course, we're dealing with a lot larger amounts of money. Typically, you have a small account you're trading, but it's tied to a MAM account with much larger money behind it. And I remember once, and also certain companies have time frames. They close their trades on Fridays. Nobody's trading on no positions open on the weekend. So you need to be able to manage your trades and your exit strategy based on closing on Friday. Others like to close at the end of the month. It's a bit frustrating if you've got a good trade running and you have to close it at the end of the month. I remember once I had a very good day on the second last day of the month. I made like 3.5% of my account in one night actually. And the investor said to me the next morning, "Brad, don't trade today." I said, "Yeah, thank you. Start again on whatever day it was, Thursday, which would be the first of the month." So that's another way to time your exit strategies, purely based on financial results. Right. So support and resistance. Well, again, support and resistance can be incredibly simple. And again, it's one of the most important things that you need to be looking at day in and day out. So here we have, and this is actually a real trade. I actually got in based on a bounce off resistance. And you can see from this chart that it was a key level. There were 1, 2, 3, 4, 5 other points where price had touched resistance and bounced back off. And I went short on it. This was, I think it was Euro Swiss, to be honest. I didn't. Okay, and I got out based on support. So this is a very simple strategy. Getting into a trade, a short trade, a bounce off resistance, and I got out of it, which was when price hit support. And as you can see by the left side of that chart, you've got clear amounts of support. Clearly, the market liked that number, and I got out. And also, I was getting bored with it. You can see the railway tracks in those candles. It just was going up and down, up and down. But if I had a bit of patience, and this is just a few weeks ago, I could have got this. So, and this really happened. I was kicking myself, kicking myself in the next couple of days, because it actually came down. I got involved in the trade with these trend lines, upper and lower, and I just decided to get out of the trade based on support, which is not a bad strategy. But of course, something happened to the euro and it tanked and it hit my lower trend line. This happens as a trader. You're going to have this. So here we have a combination of trend lines and support and resistance. So it's again, it's one that got away. You say, "Oh darn, what I'll be smarter next time." But then again, it may not have happened. So you see what happened when price did reach that lower trend line. It was quite a valid trend line as well, because if you carry on to the left, you see there are 4 more points of contact. Right. Again, so using trend lines as your entry and exit points. Here we have a Swiss pair, and basically, again, the trend is your friend. We only want to take long trades on this. So if we draw a trend line, obviously this is after the fact, we draw trend lines, and you can see 1, 2, 3, 4 points where the yellow bar is, where the yellow box is where we entered the trade, and we were wondering, hey, where are we going to get out of the trade? Well, the upper trend line. So that's exactly what happened. And you can trade this way, and you can see in this particular case, the lower trend line had 1, 2, 3, 4, 5, 6, maybe 7 contact points with swing lows, and the upper trend line had 1, 2, 3-ish, and 4 later on. So the trend lines, and I'm always drawing trend lines, are extremely valuable. So this is a very simple strategy for exit. But as we've talked about earlier, anything could happen in between these trend lines, and you need to have your emotions under control to let the price run. And that's what was happening to me today when the Kiwi dollar trade. It was up and down like crazy. In fact, I'm not going to be tempted right now to look at the trade right now, but that's what happens. I'm hoping it's going to hit the lower trend line to close the deal. But to get there, it has to pass through some serious support and resistance. So you can either trade on support and resistance, or you can wait until price hits the lower or upper trend line, depending which direction you're going. but this is a very, very valid strategy. And again, I'll get back to, if you watch my videos, you'll know I'm always looking at trend lines. Okay, and here we have a case where the same trade, we could have got into the trade, the long trade, based on an uptrend, but got out at resistance. There's nothing wrong with that as well. In fact, we could have bagged a few more pips by waiting, but in this case, we saw that resistance was quite serious back in early in the year, back in March. You can see that there were 2 points of resistance that the market thought were quite important. So there's nothing wrong with saying this is an important level. Maybe the market's not going to go any higher. I'll close now. Nothing wrong with that because it's a valid exit strategy. Okay, using indicators to time your exit and entry. Here I have as an example, and you can, as I say, there are, as you know, there are myriad indicators that you can use. Here's a very simple strategy that a lot of beginning traders use, and that's moving average crosses. And you can use moving averages as dynamic lines of support and resistance, as you know. This is a very simple strategy where you can follow any of the yellow boxes, and if you got in at any level, you could get out at the next yellow box, which is basically a cross of that particular, I think in this case, it's the 10 period versus 40 period moving average. And again, as you know, if you've ever used moving average crosses, you can tweak, use exponential versus simple, and backtest, backtest, and backtest. And there's nothing wrong with that. I personally don't use, I know from some professional traders who swear by moving average crosses. And the way they do it, the slow one is 1 quarter. Sorry, the slow one is 1/4 of the fast one. Sorry, the other way around. So in this case, I've got a 10 period versus a 40 period. That's their strategy. I find that I miss a lot using moving average crosses. It's a very conservative strategy, but again, you can use it not just to get into trades, but also to get out of trades. And you can also combine this with another indicator like MACD or RSI, or in this case, the stochastic oscillator, to help you confirm that particular exit. So here we have a case where we can use, say, Bollinger Bands. I used to trade a lot with Bollinger Bands. I think I went off them for many years, but I never ever lost touch with the stochastic oscillator. It's my favorite indicator. But here you can see if you got into a long trade on the left side of this chart, and you waited until the stochastic oscillator went into overbought and came back and closed the trade, you would have been correct. And if we move further down, you can see the yellow box in the middle of the chart. If you were short, let's say off that 20 period moving average in the Bollinger Band, and you waited until the stochastic oscillator went into oversold and crossed back up, you would have made an intelligent exit from that strategy, from that trade. And again, I can't say enough about the stochastic oscillator. It's definitely my favorite indicator. We have done webinars. There are videos on the Valutrades website about the stochastic oscillator. So that's using indicators to time your exit to trade, not just your entry, but your exit into out of trades. Okay, right, there's Fibonacci. As we talked about, a lot of big players use Fibonacci to trade day to day. And why does it work? Because it does. That's one of the beauties of the trading business. It's one of the reasons the banks aren't allowed to talk to each other these days, is because when everybody does the same thing, then price will go in that direction. And in this case, this particular one, so if every trader is using Fibonacci, then you've got a fait accompli. You have a good chance of knowing that the price is going to do something when it gets to that level. This particular chart is the Hang Seng. If you've been following the news, you'll know that the Chinese and Hong Kong equities are tanking right now. But here we have a case where if you were short on the Hang Seng, congratulations, you had a crystal ball. You may say, okay, I'm going to close it because price has now hit this key Fibonacci level. And Fibonacci is no more really than support and resistance. It's just another graphic that people use to time their exits and entries. And again, it's a matter of back testing. If you, as I always say to people who don't understand Fibonacci, if you put Fibonacci on a chart and you don't see anything lining up, then delete it. clearly is not going to work with that particular pair. So again, exit and an entry with Fibonacci can and this Fibonacci I call post-COVID. You can see I've drawn the bull run from March of 2020 up until a year later, March of 2021. And sadly, the Hang Seng has come down and tanked today and yesterday because of turmoil in China with the equity markets. And again, using Fibonacci on this particular pair, you can see how important these key levels are. The 38.2% and 23.6% are clear levels of support and resistance. So it's the same as trading an entering and exiting with support and resistance. You can use Fibonacci for the exact same thing. So if you are range trading this particular pair, if you're range trading, you're not really bothered about long or short. You can do either. You've got a lot of opportunities in this, and you can see in between the levels of Fibonacci, you had a lot of price action. And again, that gets into trading psychology. Do you have the patience to let it run to hit the next level? That's up to you. And again, the time frame you use, this particular one is a 4-hour chart. So this price action would take several, maybe days, to get from one side to the other. But again, it's a very valid strategy if Fibonacci lines up in that particular pair. Okay, I talked about managing the trade. So what does that mean? It means following the trade manually. So here's an example of, I mean, again, if you look at this trade, the green line represents our entry point. And yes, I know it's not a proper trade because we can see what's going to happen. And the entry point of the little yellow box is obviously a long trade. And we set our take profit way up here in the stratosphere on this 4-hour chart. So obviously, with the beauty of hindsight, we can actually see this trade. But I wanted to use this as an illustration about managing trades. When I say managing trades, you're looking at moving your stop loss, in this case, because it's a long trade, below the next swing low. And I'll show you what that means. So here we have prices moved on. We don't want to just arbitrarily move our stop loss before we've bagged some profit. And again, it's up to you with your trading strategy and your plan. If you say, I'm not going to move my stop loss until I'm 50% of my way to my profit target, or maybe 25%. If you keep moving your stop loss too soon, you will just simply get stopped out of trades all the time, and your risk reward ratio goes out the window, because if you have a bad trade, it's going to hit your stop loss. And if you're losing 1% per trade, you're going to lose 1% per trade. But if you keep moving your stop loss and keep getting stopped out, even in profit, you're making 0.25%, 0.5%. It's not enough to manage your risk reward ratio. So you need to decide when you're going to move your stop loss if you want to manage the trade. In this case, I've managed the trade, and again, it's only an illustration. And you notice I put the stop loss above a key level of resistance, and it's below a swing low. You may say, okay, I'm only going to go if there's 2 swing lows, or I'm only going to do this if this swing low has closed 4 candles. You can go 3 swing lows. That's a very conservative strategy, but that's up to you. You can say, no, I'm bold. I'm going to move my stop loss, and I'm going to manage the trade based on any swing low, 1 swing low with 2 candles after the bounce. It's up to you. In this case, I've just gone 1, but you can have a very conservative strategy where you want to see 2 or 3 swing lows or swing highs, depending on that. So basically, as price goes on and I see more swing lows, I can move my stop loss further and further up. And what that does for us, and again, it books the profit. So if price does reverse and hit the stop loss, it closes the trade. But you can see the difference between the stop loss and your entry point. There's some nice profit in there. And again, you need to make sure that you're booking enough profit to compensate for the trades that you lose, sadly. So we manage the trade like this. It goes higher and higher, and we keep moving it and moving it. If you move, even if you're not managing a trade, if you set your stop loss too tight, as I say, you will keep getting stopped out all the time. It's that simple. Okay, what I'm going to do now, I want to look at trailing stops, and I'm going to show you a little video. If you just bear with me a second here, I need to just quickly change the screens. Yep, that's it. Sorry for the pause there. And I'm doing this with a video editor, so I'm going to go through this a bit slowly. This is this particular trailing stop video was about several hours long, and I've edited it. So basically, what we have here, let me make sure I'm on the right. Yes, I am. Okay, so we're on MT4. You can see, hopefully, you can see these lines. We're in a buy trade on the S&P 500, and this is the 5-minute chart. I don't normally trade the S&P 500 on a 5-minute chart, neither should you, but I wanted to show you how a trailing stop works. So you can see where our entry is in the middle of the chart, where the candles finish, of course, and our stop loss is down below this swing low. So what I'm going to do is move a bit forward. So the way you get into a trailing stop, if you don't know, is you need to select the trade in your MT4 terminal. You can see it highlighted in blue down there, and I'm going to move forward slowly. So I right click on the blue bar and I see trailing stop, and I select. Okay, you need to understand that, and especially with a pair like, or not a pair, but depending on the instrument you're trading, it says 15 points. That's 1.5 pips. That's not very much. So what you need to do is be aware that points and pips are quite different when you're doing a trailing stop. Okay, excuse me. So what I do typically, I need to convert pips into points, which is quite easy, just multiply by 10. So what I've done here, I've gone custom, and I've done my measurement beforehand, and I know I want 25 pips. So I set 250 points. And this is really critical to understand. So basically, now I've got a trailing stop. I click OK, and the trailing stop is set. Okay, trailing stops don't take effect until your trade is in profit. I don't care what people say about MT4, that's the only way it works. You need to be in profit before you see any action from your trailing stop. And I'll show you now what that means. So I'm going to move the video forward a bit. I'm going to make some space here on the chart. And okay, I've put a line just to highlight it in case you don't see it. There's a red line, which is my existing stop loss. So I'm going to move forward in time very quickly. And you can see price action doing what it does, trying to go up. We're probably still in negative territory because we're below our entry point. Here I've measured it. There's 25 pips. Okay, now we're in profit, but nothing's happening yet. Okay, price is going higher and higher and higher. So I need to adjust my editor slightly here, sorry. Okay, price is going higher and higher, but it hasn't reached 25 pips yet. When it reaches 25 pips, the stop loss magically moves above your entry point. You see, I'll rewind that a bit. It literally goes bang and moves up like that. Basically what MT4 is saying then, the current price is more than 25 pips ahead of your entry point. That's how a trailing stop works. So if price reverses now and hits that stop loss, you're out of the trade, but you're in a profit. And as you can see, and I'm going to move this very slowly, the stop loss will keep moving higher and higher and higher as we get more and more chunks of 25 pips. And eventually, price will reverse, and back, oops, excuse me, price will reverse and take out the trade. So, but that's fine. You've actually made some nice pips. So it's a very important thing to do if you're having trouble with trading psychology. And I had a professional, an investor company, a hedge fund, who insisted that we use trailing stops. What we had to do though was then do a lot of practicing and tweaking, because every instrument is different. A 25 pip stop loss may be totally useless on some instruments. If you're trading a 4-hour chart on euro pound, you may want to use a 300 pip stop. I mean, you need to play with this to get it right. Obviously, the larger your trailing stop is, the more room you have to back up, which means you're not booking enough profits. So it's one of those things where you need to practice. But trailing stops can be an amazing tool to get over trading psychology and help you close more trades. And again, MT4 won't put it into effect until you're in profit. In fact, what you might want to do is not just set it up automatically, is wait until you've actually booked enough profit and then go into trailing stops. Okay, let's quickly go back to our main screen. Okay, the other thing we like to look at is what we call scaling out. And it's a lovely problem to have, is to have a trade that is well into profit and really not know what to do with it. It's a very good, so what I'm going to do now, give me a second here, I'm going to change screens, just bear with me. Get another one of my little video editing things up here. Right, here we have a trade. We are, as you can see, the green line is the entry point. This is the NASDAQ. And as we know, prices have been, equities have been going up. Today, as you can see today, there was a big drop on the equities. Everybody got nervous about what's happening in China. So hopefully we'll be doing videos on Monday about buying the dip again, because that really worked. Hopefully you saw my buy the dip video on the S&P 500, because it really, really worked. So buying the dip on equities like this is a very valid strategy. But again, the exit strategy is what we're talking about today. So here we have a thing we're calling scaling out. Let me just get my editor together so I can find the right control. Oh, pardon me. There we are. Okay, so basically we have a trade, and you can see that, I'll just move this forward a bit. So again, we have the trade, and you need to be able to right click on the terminal on that particular trade, and that trade will be highlighted in blue. Make sure you get the right trade, make sure you select the right one. So now we selected the correct trade. We know that's the one we've got. And lo and behold, we have profit of $1,400. I mean, don't you all wish you had profit of $1,400? So I'm wondering what to do with this trade. Do I close it? Do I let it run? I'm a professional trader, so I want my investor to have some money and not worry about the NASDAQ crashing tomorrow and losing all his profits. So what we can do is do a thing we call scaling out. So what we do now, we right click on the trade on the blue bar, go to modify or delete order. And this is where you need to pay attention, because MT4 is not kind to us in this area. Modify or delete order. So now we've got our chart up, our order ticket, which is a normal order ticket. When we say modify in MT4, it's looking at us to change our stop loss or take profit. That's not what we want to do in this case. And to do a scaling out exercise, you need to go to select market execution. It makes no sense, but that's what you need to select. So basically, here we have the existing trade. You can see that our volume or position size was 0.1 lots. And if you can read the yellow bar on this particular slide, on this particular chart, it says close trade number so-and-so, buy trade 0.1 by market, NASDAQ by market. So if I click that yellow bar, it would just close the trade. I don't want to close the trade. I want to close a part of it, just a part of it. So basically what we do, we go back to our volume or position size. And let's say I want to close half of it. So what's half of 0.1? 0.05. So I just changed the number to 0.05. Now you can see the yellow bar, if you can read it, now says close buy trade by 0.05. And what that means is I can click the yellow bar now, and it will do just that. It will close half my trade. So watch what happens. Okay, let me go back a bit. So if you look at the bottom of the chart, hopefully you can read these numbers. The balance of the account is $3,500. The trade right now is $1,400. So when I click this button, suddenly my balance goes up, which is great. Thanks for to me and the investor, 4,188, and the trade is now $700. So it's actually cut in half. So what I've done, I've booked half of the profit on that trade. So I can sleep easy knowing this trade is done well, and the rest of it can run or do whatever it wants to do. I know I've done my business as a trader to make money on this trade, and I can decide what to do with the rest of that balance later, the $700 later, whether I let it run, whether I set up a trailing stop, whether I wait for it to hit the upper trend line. All my different exit strategies will come into play. But again, I've booked half that profit, half that trade's profit. I'm very happy about that. Okay, so that's basically how to scale out of a trade. And again, I'm going to quickly go back and show you again. You would think that you would go on to MT4 and select modify order, but no, it's actually on market execution. So be very careful with that. Okay, MT4 has a few little tricks that can trip us up. Okay, we've got 5 minutes left, so I'm actually on time. This is one of the first webinars of my life. I'm actually running on time. Let me go back to my my main screen. Okay, we talked about financial goals. Well, a good exit strategy is just to say, hey, I've done my business for the day. I'm closing. So, and again, I've had hedge funds that have set out what they want to do on with certain trades and certain times of the day. And one of them was closing trades every Friday. That's very frustrating for a trader, but there are many companies and funds and so forth who just do not trade on the weekends. And I mean, over the last few years, we had polls for Brexit. We've had Donald Trump tweeting on the weekends. You know, even if you think back to the Scottish referendum polls, the pound was going crazy on Monday morning because of the polls that happen on the weekends. A lot of companies do not want their positions open on the weekend. So closing your trades on the Friday is not a bad strategy if you don't want to do that. But then again, you need to manage your plan and your strategies and your exit strategies to accommodate those Friday closures. And again, as I mentioned earlier, some places close their trades at the end of the month just because they want to show their investor, you know, here's where we are at the end of the month. And as I mentioned earlier, one of my best days ever was on the 30th of the month, so I took the next day off just because we wanted to book those profits during that month-end period, and we started over on the first of the month. But that's how professional traders get paid. They get paid at a high water mark every month, so it's important to follow that as well. The other way to look at it is, as I said earlier, let's say I want to make 1% per day or 0.5% per day, and I've got a trade that's running in profit, and maybe I don't care about my trend lines or my support and resistance. I see that trade in profit. I want to be sure that I get and I've met my risk reward ratio. My win rate is high, hopefully, fingers crossed. And I say, okay, I've got a certain percentage of my account is in that trade. I want to book it now, and I close the trade. There's nothing wrong with that as well. But you need to have your risk reward ratio under control, and your win rate needs to be high to be able to have that luxury of closing a trade for the sake of closing a trade. I can't stress that enough. If you're closing your trades just because you've booked 1%, and yet all your losing trades are wiping out 1% of your account, that doesn't count. That's not the way to do it. Okay, right, we're almost out of time. Hope you guys have enjoyed this. Hope it's been valuable. Let's just quickly review our exit strategies. Support and resistance. Again, I can't stress enough how important those horizontal lines are. You need to be drawing them all the time. Trend lines, again, my favorite strategy outside of chart patterns is using trend lines. I find them invaluable, and I find them very, very accurate. And as I said earlier, I've got, I think, 12 trades in a row with 2 open ones that are in profit right now, and they're all based on either chart patterns or trend lines. There was one earlier that I showed you guys that I did based on the bounce off resistance. So these 2 exit strategies and entry strategies are critical in my plan. Using indicators like moving average crosses to time your entry and exits. Fibonacci, again, very valuable if it works with that particular instrument. Managing the trade. Again, learning how to manage the trade can be invaluable. It can be very frustrating. It may not be for you. Don't set your stop losses too tight. You need to manage whether you want to do it every swing low, swing high, 2 swing lows, 2 swing highs. How many candles constitute a swing low or a swing high? It's up to you how conservative you want to be with your managing of the trade. Trailing stops, again, can take away so many psychological issues, trading psychology problems. Again, you need to see how big that trailing stop is. If it's too big, you're throwing away profit. If it's too small, you're getting stopped out too soon. Scaling out. Hopefully you'll have the problem of having big profits in trades. You don't know what to do with them. It's such a very good feeling to be able to scale out of a trade, book half your profit, book a third of the profit, book 2/3 of the profit, and carry on. It's a very valuable method for managing your profit in MT4. And there's financial goals. Have I made my quota for the day or the week? Great. Let's get out of the trade and carry on. Let's have a good weekend. Well, I hope it's been valuable. Any questions, just either fire me a note on YouTube or send a note off to the wonderful customer service team at Valutrades, and we'll get back to you as soon as we can with any questions on entering or exiting trades. Thanks for watching, and we'll see you soon, and keep watching Monday and Tuesdays for the videos. Okay, guys, take care.